Hi, I'm Nathan Moeder with London Moeder Advisors, and this is a short video on interest rates and what's going on with the Fed and are we done? So a lot of stuff that we're talking about here in the office and throughout the industry. So I thought I'd shed a couple slides on the topic, and here we go. So this first slide shows the federal discount rate and the cumulative increase that happened every single time the Fed went on an increased strategy of trying to slow down the economy. I'll just pick the line here in red. In red was the 2005 to 2006 period, which was the last time before the financial crisis. As the Fed was trying to slow things down, they were increasing rates. And what happened over this time period, it was a total of 26 months, and the Fed increased it by 425 basis points. Now, basis points means that 100 basis points is 1%. So basically, this is 4.25% is where the discount rate increased from and to as a cumulative value. I'm showing 2016 to 2018, just before COVID. They were trying to slow down some things. They increased it 200 basis points. What happened in the last couple years is the Fed has really been trying to slow things down. And that's this blue line up here. And what you can see, it's the biggest, the largest increase, 5.25%, 525 basis points over a period of 20 months. And we've probably seen some of these charts before, and you've heard people say that the Fed increased the fastest, the sharpest, and the most amount trying to slow things down. This had a huge impact on markets. What's not being asked, or what I don't see in being studied, is what happens after the Fed is done increasing rates. So I want to take a minute to kind of show what happened after each one of these periods. So this next slide shows in these dark blue boxes what happened to Treasury rates about 1 year after the Fed said we're done increasing and we're just going to see how things play out. Basically, what happened over these time periods, nothing really happened in 2005 to 2006, a year later. It actually took another year or two for the markets to unravel. And as we know, the financial crisis hit, and then treasuries dropped after that. 2016 to 18 period, treasuries dropped a year later, by the time we hit 2019, by 97 basis points. That's almost 1%. Treasuries dropped by. 94 to 96, it dropped by 166 basis points. That's 1.6%. So what happens is the treasuries tend to decline after the Fed says they're done increasing. And what the Fed's trying to do is just to get the predictability of the market in place. The economy, the Fed, if you can't predict what's going to happen in the future, there's lots of uncertainty. So that's why when the Fed is increasing rates, there's a tendency for the Treasury bill to increase as well. When the Fed signals that they're done, like they have in the last month, treasuries start to come down because now there's certainty in the marketplace. People know, okay, the Fed is finished. Maybe they have inflation under control. Maybe we'll do a soft landing, but at least it's predictable that rates will not be increasing for right now because the Fed is signaling that they may be done. So as a result, treasuries start to decline. And this next slide here will show that. What this slide shows is the 10-year has declined from about 5%, 4.98% in October of 23, all the way down to 4.23%, the current value. And that's a drop of about 75 basis points. So this has been at the same time that the Fed has been signaling that they may be done increasing the discount rate. Now institutions are going back into treasury bills, thinking that there's some predictability in the market, some stability, and we've seen this drop now to 4.2%. I anticipate that this will continue to drop. The previous slide showed a decrease of about 100 basis points to 166 basis points. I think we're about halfway there. I think I would not be surprised if we're seeing 150 total basis points being shaved off the Treasury by the time we reach the end of 2024. So over the next year, all things and all signals being positive that we still have a stable economy. It is a soft landing. then I think we can see the Treasury come down even further. The pundits that I'm hearing and that I'm talking to is that it could be in that 3.5% range for the US Treasuries. Now, what does that mean for mortgage rates? Mortgage rates, we have to look at what the spread is on top of the Treasury that's added by banks for that additional risk. That's in this next chart here. So this shows the basis point spread over 30-year mortgages for each of the periods where the Fed was increasing rates. And what I want to start with here is these green dots over here on the left in this black box. This is the basis point spread for 30-year mortgages on top of the Treasury. So typically it looks like about 110 to 160 basis points that banks and institutions were adding on to the Treasury. And as the economy worked through what it was working through, as the Fed was increasing rates during each of these cycles, when the Fed was finished, that's all these green dots over here on the right-hand side. So a year later, after the Fed finished, you can see that there's a range. All these green dots is a year after the Fed was finished. And the basis points were about 125 to 200. On average, it's about 180 basis points. So when things stabilize, you would anticipate that about 180, maybe 150 basis points on top of Treasuries for these mortgages. This blue line up above is where we're at today. I don't think we've priced in the correction yet of this spread. What has happened this last go around in 2022, 2023, because inflation was so high and because the Fed was acting so fast and increasing rates, there was additional uncertainty by the banks. So as a result, the banks have been adding additional spread to compensate for that risk. So all these blue lines you can see are above 250 basis points consistently for the last 6 months. That's because nobody knew when the end was in sight, and the banks wanted an extra cushion in their spread. So that's a big add-on that banks were adding. I anticipate that this would start to fall down into a normal range. So over the course of the next year, maybe we would see the spread fall back to that 150 to 180 basis point spread range on top of Treasuries. So what does that mean? If we have Treasuries that stabilize at a 3.5% range, you add 1.5 basis points, 1.8 or 180 basis points. What we're talking about is interest rates at about 5.25, 5 to 5.25. So I think that is a good outlook for this next year. By the end of 2024, hopefully we see mortgages come down to 5 to 5.25 range. I've talked with other people that believe that that may be high, that we might see an even quicker correction on this because of how fast we're trying to unwind things and get it under control. It might swing the other way now, and maybe Treasuries would drop to maybe 3.25 or right around 3. I'm going with 3.5 at 180 basis points. That gets us to the low 5.25 range, maybe 5. And I think this is going to do a lot for feasibility for projects. We're going to see more projects come back to the table, to the development process, because now mortgages will make sense for these things to pencil out and to finance. And that hasn't been the case for 2023. So I think the worst is behind us. Our shop thinks the worst is behind us. We have a lot of positivity going into 2024. And as long as the Fed has it under control, and if we get a soft landing, I think we can see, the debt markets stabilize and create some incentives for development into 2024. And I'm Nathan Moeder, and thanks for listening.